Thank you all so much for joining. So our mission here at the Denver chapter of the Colorado Renewable Energy Society is to support a 100% renewable Colorado through education, engagement, and connection to networking opportunities across all Denver communities. Our values are renewables, emerging technologies, efficiency, diversity, inclusion, and community. We are a statewide group. We are nonpartisan and nonprofit. So tonight, if it's your first time joining us, welcome. And to those of you who've been to presentations before, thanks for returning for our 2022 year. I'll go through a few announcements. I will switch it over to our Director of Policy, Jonathan Rogers, who will go through some policy announcements, and then we will turn it over for our feature presentation this evening. So we encourage you, especially as you're thinking about how to spend time in the new year, to become a member of CRES. It's fun. We are working on ways to increase engagement during this continued pandemic this year, so keep an eye out for that. And you can learn more about our activities at www.cres-energy.com or .org, excuse me. Everything you need to know about how to become a member can be found there. And we do want to hear your feedback. So if you have any ideas for speaker series, for how you might want to get more involved for volunteer events, please send that to us. You can send me a message in the question box this evening, or you can send us an email at mdcres@cres-energy.org. We also appreciate your donations. If you'd like to do so, you can do so online at our website. You can send us some funds via Venmo at MDCRES on Venmo, or if you'd like to support us when you shop, you can change your charity of choice on Amazon Smile. And every purchase from Amazon, a small portion will go to CRES to help keep us funded. And with that, I will turn it over. Actually, sorry, one more quick announcement that's not here. Kind of shameless personal plug. I work for Aero Electronics in my day job when I'm not volunteering as the Director of Sustainability, and we are actively trying to hire for a manager of sustainability to join our team. If you are interested in applying or know someone who might be, I encourage you to go check out the posting on our website at aero.com and take a look and hopefully join us as we strive to be a more climate-friendly company and make improvements there. So thanks for letting me throw that in. And with that, I'll turn it over to Johnny for a policy update.
Great. Thank you so much, Lindsay. So in national news, you may have heard that the Build Back Better Act has stalled in the Senate, could not get the votes needed to pass. But it's gotten to a point where specific portions of that bill might get pulled out and voted on. And the climate portions of Build Back Better are something that have really risen to the top. Even Senator Joe Manchin has expressed a lot of support for things that were in there. So Democrats are taking a new tactic, which could be great from a climate perspective. There's a lot of funding for clean energy programs and things that could really benefit communities across the country. So we'll see what happens, and next month hopefully have a good update on this front. Next slide, please. So in Colorado, the legislative session has kicked off. The session just started last week and should typically run through early May or so. The first bills that we've seen, and we expect there are many more to come, but these first ones are focusing now on getting kind of creative with what technologies can we use to further advance our climate goals. Back in 2019 was the big year that we experienced the state setting some really ambitious carbon reduction targets, really setting the goalposts that we need to get to. And now some of the bills are more focused on individual technologies. So the first one would provide tax exemptions for air source and ground source heat pumps. The second would study the use of small modular nuclear reactors as a source of carbon-free energy in the state. This third bill would provide grant funding to build microgrids in rural communities that face climate risks. So thinking of those communities that might be more subjected to wildfires or floods or extreme weather events, ensuring that they've got more local and distributed energy resources that can help them to continue to operate through those extreme events. In the last bill, it wouldn't be a legislative session without an attempt to ban on natural gas. This is very likely to be defeated before it ever gets out of the Energy Committee, but there's always an attempt out there to try to protect fossil fuel interests. You can go to the next slide. It focuses on what's going on in the regulatory space. So as laws get passed, it's up to the state regulators to implement them. And at the Public Utilities Commission, that's also where Xcel Energy files its plans for, well, how is it actually going to add renewables to the grid to comply with these ambitious state targets. Earlier this month, Xcel filed their Renewable Energy Standard Plan to add about 1 gigawatt of renewables between 2022 and 2025. And this is a significant jump based compared to their previous plan. But our goals are more. And how do we make sure that these programs are distributed equitably across Denver's communities and elsewhere in the state to make sure that the benefits of the energy transition are being shared with the people that tend to benefit from them the most. We can go to the next slide. And my last update is in local news. The launched a Renewables and Resilience Incentive Program for human service providers. So they get profits like affordable housing providers, food pantries, homeless shelters. The goal is to help fund projects that can power those facilities with clean energy and also help them keep the lights on through crisis situations, extreme weather events. Now, these are the community-based organizations that are really out providing critical life-saving services to the communities that they support, and for us to make sure that can continue to happen. You can learn more about the program at denvergov.org/solar. And the first quarter applications are due January 31st. That effectively just confirms that the applicant is a qualified nonprofit human service provider. Then they'll be given instructions for next steps to actually come back with a project price quote and more details on how things will happen in the future. Denver set aside $3 million of funding for this first year. Applications are going to be reviewed quarterly, and are really hopeful that we see some exciting projects that can make a big difference in the communities that they're located in. And that is it for me. And if you have questions about things going on in the policy space, always feel free to reach out and be happy to try to get you an answer. Thanks, and can't wait for Greg's presentation.
Thank you very much, Johnny. I appreciate that. And without further ado, I am very excited to welcome Greg to our speaker series in January. Greg has been a member of CRES for a while now and has been driving our programming efforts in the background for years at this point. And so very thankful to actually be able to hear from Greg this evening as he speaks to us about climate change through the insurance lens. So I'm excited to know if there's opportunities here or abilities to innovate. And so with that, I will make you presenter, Greg, and turn my video off and turn things over to you.
Thank you, Lindsay. Anyway, it's a great honor to be here and speak to you folks. As Lindsay mentioned, I'm the program director for the Denver chapter of the Colorado Renewable Energy Society, but I'm also a volunteer and group leader for Citizens Climate Lobby, the Denver chapter. And I also participate in a spinoff operation. So Citizens Climate Lobby is advocating at the federal level for putting a price on carbon with a border adjustment, or a price on petroleum products, all the carbon products, with a border adjustment and then a dividend payable to each citizen monthly. And they have a spinoff operation, Business Climate Leaders, which advocates for the same thing, but tries to get endorsements from corporations and things like that. So you can see the title of my presentation is Climate Change Through the Insurance Lens, Innovation and Opportunity. I wanted to do this topic One obvious reason is I work in the insurance industry. So, climate change being a global event is going to touch on many aspects of human enterprise and activity, insurance being just one of them. But I also want to do this topic because I think it's time that this conversation about climate change matures. So much of the narrative, so much of the imagery focuses on things that are very far away, things that are very concerning, very alarming, yes, but very far away. We have stranded polar bears up in the north, starving polar bears. We've got calving icebergs off of the Antarctic ice sheet. We've got retreating polar ice caps, and then in Siberia, we've got the drunken force of the taiga, where the permafrost is melting at such a rate that the root integrity is not great enough to hold the trees up any longer, and they're just all falling over. So, I find these images and narrative very concerning and very alarming because this is the planet I live on, right? But these are things that are very far away. I don't know that this imagery, this discussion motivates people to take action now. And now is the time. In fact, we're past that time and we have to take action. So I think it's time, I think in order to instill more motivation for people to take action, we need to bring things home. Talk about how the climate change will affect our wallets, our backyards, our communities, the jobs in our communities, the economy, our retirement portfolios, the finances. All of these things are going to be touched by climate change. Insurance is just one of these areas. And it just seems like it's time, if we focus on that, we might be able to get more action for now to make it more relevant for us now. So that's part of the reason. In the second half of my title, as you'll see, I presume is surprising to you all, innovation and opportunity. So much of the narrative, the discussion about climate change includes tales of doom and gloom. And it's hard not to talk about climate change and talk about the negative effects of climate change. But there is, at least in the insurance industry, some opportunity to thrive. Now, there's a specific segment I'm referring to in the insurance industry. This should be surprising to you because it's the insurance companies are the ones whose job it is to pay for the effects of climate change. They pay for the cleanup, the rebuilding efforts. And, we can all identify with this right now because not far away from us, just a few miles away from us in near Boulder, there was the Marshall Fire, where there's now 1,000 families who are now homeless because of this. And 2/3 of those families are uninsured, meaning they're not going to get full value for their homes to rebuild. They're going to have to pay for part of that rebuilding out of their own pockets. So these are the signals of climate change we're experiencing in our community. And see, insurance companies whose job it is to, of course, take care of these folks. So why would they be optimistic? Well, I'm specifically referring to the reinsurance industry. This is the aspect of the insurance industry that pays for those claims that primary insurers cannot, which should be surprising because they pay for the worst effects, yet they have found an opportunity in climate change. And that's what we're going to be talking about in this presentation. So as you know, I'm Greg Winchell. I'm a volunteer at MDCRES and for CCL and BCL. By day, I work for an insurance company. I have done so for almost 20 years. It'll be 20 years this April. I've been in my specific job title at the insurance company is a fraud investigator, which I've done for 25 years. But, I'm not going to be talking about that today. I'll be talking about my insurance experience. But what brings me here to this group to talk about climate is an insurance, of course, because nobody really wants to preserve insurance companies from climate change, right? That's their job to help us, right? What brings me here is, well, like all good stories, it begins with my wife. I actually met my wife in junior high. We actually became an item in our college years. She grew up as a skier. I think at the age of 7 or something like that, she started skiing. She and her whole family would ski, and she then joined the junior patrol up in Winter Park, then graduated and matured into the senior patrol in Winter Park. So I realized if I was going to get with this girl, I was going to have to take up skiing, which was no sacrifice because, you know, I had an interest in skiing. I just never had much opportunity growing up, and here was my opportunity. So we spent our weekends skiing. When I'd go on vacation with her mom and dad, we'd go on ski trips. Later, we got married and had kids, and we raised them on skis. So skiing is a part of our lives. But as the conversation on climate change became more urgent in times past, I've realized slowly that there could be a time in my lifetime when the ski season becomes so short as to no longer allow to be economically viable for the ski industry. And maybe you all would not lament my, the sadness of my family that we can't ski, but think about the tourist industry, the dollars it brings in, the people, the destination travelers come here for the ski industry, and that makes the mountains and the ski industry kind of a calling card to bring other types of recreational people to expand that segment of our economy here in Colorado. So it's a vital part of our economy, which again, I think is sad and can harm our economy. All right, so that's enough about me. Let's talk about our presentation this evening. Here's the agenda for the evening. I'm going to try to put insurance into perspective for you, place it on the economic map, if you will. We're going to be tossing around a lot of big numbers this evening. I want to give you some perspective on where these numbers fit into in the scheme of things. I want to try to make a case that insurance in some situations can influence our behavior in a way more effectively than perhaps government regulation cannot. We'll talk about how the insurance industry views climate. Then I'm going to introduce you to the reinsurance industry, which are the folks who insure the insurance industry. Their innovative solution, their adaptation to this peril that we face is the catastrophe bond or cat bond. So I'll introduce you to that as well, which opens up new opportunities for them to sell their product, their insurance instruments to new markets and develop new technologies and so on, as well as we'll end on a case study of an insurance instrument called the solar revenue put. So I just try that's the agenda. I'm going to try to put things into perspective for you. Try to place insurance on the economic map. The gross domestic product in the United States for 2021 was $23 trillion. $23 trillion. That is the sum of all sales, for that year. If I buy a stick of gum, the GDP goes up by 75 cents. If a hurricane hits the Gulf Coast, it also goes up because people have to leave their homes and move into hotels. We have to rebuild. We have to do cleanup. It's just a summation of sales. Now, there could be an analysis. There's harm as well because now business is closed because they're damaged and people lose their jobs. So my point being here that the GDP is not an index on the quality of life. It's simply the sum of sales. Now, if we're going to talk about insurance companies, we have to talk about the stock and bond market, which is a $75 trillion market if you combine it. Why do we need to talk about this? Because insurance companies actually, surprisingly, don't make much money off of the premium, much money at all actually, off the premium that you pay to your insurance company for coverage. And premium is the name for the dollars that you spend to buy coverage. It's called premium. It's such a fiercely competitive market that the insurance companies really don't make money there. However, they don't just take your money, put it in the bank account, and wait for one of you out there in the audience to file a claim. They put that money to work. They invest it in the stock and bond market, which is, again, as I'm saying here, a $75 trillion market. If you break it down further, the stock and bond market, 45% or 34 trillion are invested in stocks, 55% or 41 trillion is invested in bonds. Now that's across the entire market. This is not the insurance, what the insurance companies invest in. This information comes to you by way of the Insurance Information Institute, the fact book. It's actually 2021 fact book. I need to update that. Now, insurance companies own 5.8 trillion of that market, or 7%. Now, they are a very conservative investor. Most of their investments are in bonds, or 4 trillion, or 69% here. 8% in stocks, 9% in mortgage, and then 13% miscellaneous. This is important to think about when you think about insurance companies, because some of those investments are in, excuse me, the fossil fuel industry, because they diversify their portfolio like everyone else does. I think the fossil fuel industry 7-8 years ago was around 14% of the stock market. It's now down to around 4 to 5%. And insurance companies invest in the fossil fuels. But there is a movement within the insurance industry to start divesting because of the risk that encouraging that market entails. And of course, when you're investing in a fossil fuel company, you're giving them money to develop their business further. You're basically financing their operations. Let's analyze insurance premium in the United States. Of that $23 trillion, we spend 2.14 trillion of our GDP on insurance premium, or 9.7%. If you analyze that further, 48% is spent on private health insurance. And I believe if you include all insurance, including governmental insurance, it's at least double this figure, maybe, I think it's closer to triple. Now, 1/4 of those insurance premiums are spent on property and casualty insurance. Now, that's the things that you're familiar with, like auto insurance, homeowners insurance, general liability, things like that. The other 1/4 is spent on life and annuity, life insurance, 600 billion, or 24%. Now, way down here, we have 3% of the reinsurance industry. 3% of our premium is spent on reinsurance, or $85 billion. Remember, these are the folks that pay for the risk that these guys, the primary insurers, cannot cover. The very extreme but very rare, the very rare but very expensive events. Now, when I began this project, this research, this is where I put my attention on the property casualty and life and annuity, because I thought that's where I'd find this story. This area of the insurance industry is relatively mute on climate change, much to my disappointment. There is discussion, but there's not much action. There's awareness of increasing risk, but there is not a lot of action. But you know where I saw action? Well, the skinny little 3% down here, the reinsurance industry. So why would that be? Well, for one thing, it seems fairly self-evident. The reinsurers pay for the risk the primary insurers can't handle, the very rare but very expensive events. So they're the ones that clean up the Hurricane Katrinas, Hurricane Marias, Irma, Harvey that hit Texas and Puerto Rico. They cover the extreme events, so they have a greater risk. They have more skin in the game. But there's a second reason as well that I think is probably just as important. All of the primary insurers, I mean, not all of them, a bunch of them are headquartered in the US. And as you are well aware, it's controversial to talk about climate change, and the insurance industry is very conservative. So they tend to be mute about climate change. The reinsurers, however, are headquartered in Europe, where it's culturally and socially acceptable to talk about, in fact, encouraged to talk about climate change. So their business models, these reinsurers' business models, are all very public, very open, addressing climate change. They're free to adapt and talk about climate change. All right, so let's talk about employment in the insurance industry. In the US, 1.52 million people are insured by insurance companies. Of this 1.52 million, 29,000 are employed by reinsurers. All right, so in the preceding slides, I just try to make a case, or not really make a case, but try to place insurance in perspective for you. Place it on the economic map so the numbers we're going to talk about make sense. In this next couple slides, I'm going to try to make a case that, that perhaps insurance companies are in a position to affect our behavior more effectively than government regulation can. And I'd like you to reflect on your own insurance concerns. I, for one, I own a chili pepper red Mini Cooper. I got that car 12 years ago because it's very fuel efficient. And I was concerned about climate. But I have to admit, I also saw the movie The Italian Job, which is a very fun movie. And I like the car, and a Prius just isn't as exciting as a little Mini Cooper. And my little car gets great gas mileage. But you know what? As I said, that car is 12 years old. I'm on the same set of brakes. I've not changed the brakes in 12 years. Why? Because I downshift and corner. Now, I've gone through tires like crazy. I go through tires about once every year or two. They don't last long. But my brakes are fine. But you know what keeps my speed in check? It's that concern over my premiums going up if I were to get tickets, because the insurance company checks my driving record every year and they'll raise my rates. Yeah, I'm concerned about getting a ticket. I'm concerned about getting points and losing my license. That's factoring. But you know what figures largely in my mind is the premium that I pay. I don't want my insurance rates to go up. You think about when I applied for life insurance, they asked me questions. Do I scuba dive in the past? Have I scuba dived in the past 5 years? Have I been skydiving? So they're attempting to influence you away from risky behavior. That's what insurance companies do. Here's a case study of the Irwindale Police Department in Irwindale, California. This police department was facing lawsuits, skyrocketing lawsuits for police brutality, violence, sexual assault, and this sort of thing. The city of Irwindale tried to reform the department, hiring new police chiefs and providing training, but nothing worked. Finally, the insurance company said, we had enough. We cannot insure you. We cannot afford you. We're canceling our insurance. Now that's what got the Irwindale Police Department's attention, because when you can't insure them, the city of Irwindale realized they can't pay for those lawsuits. They need the insurance company for that. They would have to shut down the police department. Everybody would lose their jobs and lose their police department for the city, and then the county would have to take over. Now, that got their attention. The city of Irwindale went to the insurance company and said, give us a second chance. We'll work with you. So the insurance company agreed to continue coverage, but they must accept their terms. The insurance company required them to fire their police chief, get a new police chief that they had to approve. They brought in safety consultants that the insurance company approved and brought in. Everyone had to reapply for their jobs and re-interview. And then they were able to get their lawsuits under control. And that's what made a difference for the city of Irwindale. In this particular case, the insurance company. So in the preceding slide, I just try to make the case that sometimes insurance companies can, in some situations, not all, but in some situations can affect our behavior in a way that government regulation cannot. So now I'd like to talk about how insurance companies view climate change. And in a word, dollars. Insurance companies view everything in terms of dollars, what it's going to cost them, because that's what they do. That's how they try to make you whole. Once you file a claim, they give you money. So everything translates into dollars. What you're seeing here is a hurricane table from 1860 over here in the far left up to 2020 in 10-year increments. This data comes from the National Oceanic Atmospheric Administration. It's category 3 or greater hurricanes. It's an unmistakable upward trend here leading up to the present. This is an event I'd like you to try to retain for this presentation, this moment. Hurricane Andrew in 1992. I'm going to try to put on my camera and hopefully it doesn't bog down the signal. Let me know if the audio gets bad and I can turn it off. Anyway, Hurricane Andrew 1992 was a watershed moment. It was a wake-up call for the insurance industry. They had been in a slumber and this had wakened them. And you notice this moment occurs at the end of this slump. Now, when you study the data, what's actually happening here, there actually were more hurricanes than are reported in this graph. But what's happening is the hurricanes were out in the Atlantic and in the Gulf, approaching the coast, and they'd turn around and go right back out to sea. We got lucky during this 10-year period, and this is the wake-up call moment. Other events are Hurricanes Katrina and Wilma in 2005. Katrina hit New Orleans. Hurricane Sandy, Superstorm Sandy, 2012. Hurricanes Harvey, Maria, and Irma in 2017 hit Texas, and I think Maria was Puerto Rico, I believe. I'm not sure, I can't remember where Irma hit. This is the top 10 costliest hurricanes in the US from of all time. again from the Insurance Information Institute. You'll notice the dates here are all since 2004. It actually start in what, 2005 forward, 2004, sorry. With one exception, Hurricane Andrew, which that comes up again in 1992. That was the change. Hurricane Katrina weighs in at $85 billion. In 2017, we have Maria, Irma, and Harvey. This is a combined $93 billion, $94 billion, and so on down the line. All in the past 2 decades. Now, this is an interesting graph here. It's put together by actuaries. Actuaries are the intellectual heart, if you will, of the insurance industry. Their discipline, their science is based on history. The past is the best predictor of the future. If you know what your claims are in the past, you can pretty much guess what with some variability, what your claims will be in the future. And that has always worked up until this point. This will be about 1990. This graph you're seeing is produced by a collaborative effort of 2 or 3 different actuarial professional associations. They collaborated over this concern with climate change. What you're seeing is weather variability, 0 here being the baseline. Sometimes it varies above and sometimes below. Of course, we've got time from 1961 up through 2016. What you're seeing here is a super score of 3 weather variables. We've got wind variability, moisture precipitation, and the third one is temperature variability, combined into one super score. Sometimes it's below normal, sometimes it's above. And up until about 1990, it was the weather varied below versus above normal about the same amount of time. And then we have this break. We enter into a new world here. Now, history does not predict the future. Actuaries can't use the past. They need new risk models, a new way of modeling risk, because the past just isn't going to do it. So here's what the insurance companies did, and particularly the reinsurance companies did to adapt. They adopted a multidisciplinary approach where they began to hire climatologists, meteorologists, computer scientists, economists to value the assets at risk, engineers, and so on, to produce a multidisciplinary produced risk models using artificial intelligence to produce risk models that then become the foundation for future products they can sell and future adaptations. Now they have better risk models to model the coming risk of climate change. This graph is not a great graph, but I just like it because it comes from, if you look down here, Munich Re. This is a reinsurance company. Every time you see an RE at the end of an insurance company's name, they are a reinsurer. And that's these are California wildfire events from 1980 to 2018. Up here on the right, you see this dramatic uptick. Again, from the Insurance Information Institute, the Insurance Fact Book from 2021, these are the top 10 costliest fires in the US. Top of the list is the Camp Fire, $10 billion, $10 billion. 2017, that was the same year as, if you remember, Irma, Harvey, and Maria, which was one of the big years for hurricane risk. Also that year, I think there's probably, this is another signal of climate change. We had 2 of the biggest fires ever, weighing in at a combined, $13 billion, $14 billion, Tubbs Fire and Atlas Fire, and so on down the line. You notice again, just like the top 10 hurricanes, they're all since 2003 forward, and 1991 is the exception, which isn't too far off of when we saw that Hurricane Andrew. Must have been a hot year. I'm no meteorologist, but I'm guessing that was a hot year. Now, this is an interesting graph here. It comes from Swiss Re. But I like this graph not only because it comes from Swiss Re, but because it was a wake up. It sent a signal to the CEOs of the insurance companies, because what this graph does in billions of dollars, it compares 3 primary perils that put insurance companies at risk. Over here on the left in the darker blue, hopefully you can see the color distinction. Earthquakes and tsunamis in the dark blue. You see that here, here, and here. We've got weather-related events. These are the weather-related events, the lighter blue colors here, and man-made events. So earthquakes and tsunamis are geologically based, not weather-related, obviously. Those remain relatively flat. We have a couple of dramatic events here, I think. Oh, well, I jumped ahead here. I jumped the shark, you might say. We've got man-made events, which are in fact flat. Those are things like gas leaks and factory explosions. And this event here, this tall yellow section here, is September 11th. We have the Fukushima plant here. That was a geologic event. But otherwise, everything's pretty flat except for weather-related events. And that's what sent a signal to the insurance executives that climate change is a risk they need to pay attention to, or should be paying attention to. And this is the red line as the upward trend line. Cost projections of climate change under 3 scenarios: 1.5 degrees centigrade, and 2 degrees, and 3.7 by 2100. 1.5 degrees centigrade is a best case scenario for us. At this point, we're lucky if we can make this. If we take aggressive action, we can reach this goal. I guess if we take super aggressive action, if we did a war effort, a World War II type war effort, maybe we can better this. But we're probably going to hit 1.5 degrees Celsius, which is going to cost us 54 trillion by 2100. 2 degrees Celsius is within with range. That's just a half degree warmer. Another 50% increase in cost, 69 trillion. And if we take business as usual, this is a best case scenario, 3.7 degrees centigrade at 551 trillion. Remember, this is a $23 trillion economy, and this is what we're looking at spending. I like this slide because it makes a point that we're going to pay. We're not getting out of it. Those people who say, you know, climate mitigation efforts are just too costly, we're going to pay. You're not just not getting out of it. It's a question of how do you want to finance this transition? Those are the questions we ask. There's more efficient ways of doing it, or there's more expensive ways, and that is doing nothing or dragging our feet. All right. So I just tried to tell you the story from how insurance companies look at it. Let's talk. I'm going to introduce you to the reinsurance industry in these next slides. So primary insurers focus on the mainstream area. So along this axis, we've got the frequency or incidences of a type of claim. And along the bottom axis here, we've got increasing expense. So out here, we've got very expensive but rare events. Primary insurers cover mainstream risks, the very common things. The lower risks down here, the lower rest are things you just pay for out of pocket, probably. Now, reinsurance industry covers the extreme risks, the very extreme things, the very rare, but very costly things. These are the risks that the insurance companies can't cover. That's where they come in. So how does the reinsurers pay for these extreme and very expensive events? Their innovation to adapt is the catastrophe bond, or cat bond. The story of the cat bond begins with this event, Hurricane Andrew, 1992, which was a Category 5 hurricane that in 1992 cost $27 billion, killed 65 people. The destruction was unprecedented and shocking. Nobody had prepared for this, certainly not the insurance companies. They were in a slumber. There's a number of factors that made this such a terrible event, most of which are just the insurance companies were asleep at the wheel. One is we saw in that NOAA graph that there hadn't been hurricanes for 10 years, and we had just gotten lucky. That's part of the reason. Another factor is the value of the assets being built in Miami at that time were increasing in value, and again, nobody paid attention. The third factor is, again, nobody's paying attention to the hurricane risk, so the building standards were subpar, and so they're very easily victimized by hurricanes. 11 insurance companies declared bankruptcy or went out of business. The rest were severely harmed, and many wanted to pull out. The state of Florida had to come in and prevent them from leaving. This creates a crisis, obviously, in the insurance industry, how to resuscitate, how to preserve the insurance industry, because think about what role the insurance industry has in an economy. Banks will not loan to rebuild a property if there's no insurance company to cover that asset, because the bank wants their asset covered by insurance. That would kill the economy. It would kill the rebuilding effort. So you have to have insurance. It's an integral part of the rebuilding process. But the insurance companies realized that the existing insurance risk pools, because that's what insurance companies do, they pool the risk among many different parties, was inadequate to meet the risk that they faced with the hurricane that they now were aware were coming. So they had to find something larger than an insurance risk pool to transfer the risk to. And here's what their solution was. They wanted to transfer the risk, or the word is cede, or transfer that risk to the worldwide economy, which is a $225 trillion economy. Now that's a risk pool that can handle climate change or these types of hurricane risks. That's large enough. So how are they going to access this risk pool? Reinsurance companies, the way they access, they create a corporation, a legally separate corporation. In this case, we're calling it ABC Cat Corp. They attract investors and contribute dollars into this company. They use those investment funds to buy the safest, most secure investment in the world, treasury bonds, which return a 1 or 2% return annually over a long term. Then the reinsurance companies make up the difference in terms of producing a higher rate of return by contributing the premium dollars that they collect from their customers, the insurance companies. That way investors can get their higher rate of return. And at its heyday, about 7 to 8 years ago, cat bonds are returning a rate of return of about 15%, which is pretty dang high, from the safest, most secure investment in the world, treasury bonds, backed up by reinsurance industries, which are one of the most secure and safe industries in the world as well. What's in it for the investor? Now think about it. What would the investor want out of this? Because the sole purpose of this cat bond is to liquidate in the event of a catastrophic event, and they would lose everything. So why would they want to invest in a cat bond? Well, as I mentioned, they have a high rate of return, 10 to 15%, with a known loss, which they can build into prospectus, of 3.9 to 5.6%. So how do they arrive at this figure, this known loss, given we're entering into an unforeseen world? Well, remember that actuaries climate index I showed you earlier. They hire climatologists and a manner of scientists, and using artificial intelligence, they develop advanced climate models which can predict the risk with much greater accuracy than before. They feel they know the risk. So that's part of the equation. Guaranteed returns. Remember, this is treasury bonds backed by an insurance company, safe and secure. But they also narrow the investor's risk. Whereas your typical bond is 5, 10, 20 years, these investment exposures are 1 to 2 year investments, and then they get out. They bring in another round of investors, and they just keep cycling them through. It allows the investor to diversify their portfolio in a very dramatic way. Typical investment portfolios are based still on the human-made market. However, cat bonds are based on a completely different cycle, weather, which, believe it or not, is more predictable than the human-made market. And I also offer narrow triggers. So a cat bond will be defined in terms of specific geographic area of the coast or what have you, not just the entire Atlantic coast or Gulf Coast, but a specific segment. So you're narrowing your risk. Your screen should have gone blank right now, and that's deliberate because I want you to reflect for a moment. Think about what's been accomplished here. These folks, these reinsurers, have figured out how to profit from catastrophe by augmenting their actuaries, by adding climatologists and other scientists, computers, computer modeling, and so on. They've figured out how to correctly put a price on catastrophe. They've quantified the risk, and then in turn found an appropriate market that can provide reliable return on the catastrophe market with clear market signals. Pricing, by signals I mean pricing. The market can adapt even to catastrophe. The reinsurers have unlocked the genius of the free market. All right, so the cat bond market has exploded. You can see this graph here is showing the growth of cat bond sales, if you will, starting in 1997, very slow at first. This would be, 5 years after Hurricane Andrew, because I needed that solution to address the risk. The bump in 2007, and it peaked right around, in terms of returns, it peaked around, I think it was around 2015, 2016 at 15 to 16% returns. In this next graph, I'm showing you what proportion of those internet insurance-linked securities are cat bonds. The dark blue here is the proportion of sales of cat bonds. The pink looks like mortgage securities and so on, starting from 1997 all the way up to 2021. What you're seeing here is a list of the reinsurers who are most prominent in addressing climate change, the most public. Again, just to remind you, if you see an RE at the end, that means reinsurer. Here's a glance at the Hanover Re site. Sustainability Report 2019, Sustainability Strategy of Hanover Re Group, Hanover Re Sustainability Fact Sheet. See here the tailor-made risk solutions. These are the new insurance products they are selling as a result of their newfound expertise with this newfound risk modeling. It's given them the confidence. They've got the risk models that they can sell the databases to other businesses, other industries to help them in their climate forecasting. Also, they have consulting services they can offer. So they're diversifying the products they can offer in terms of risk management. Munich Re, click on the solutions button and you get this. Up here, you've got weather risks, bioenergy, plant performance insurance. They're selling insurance on bioenergy plant performance, not on the plant itself, not on the asset itself, but on the performance of the plant. Solar energy insurance directly for the asset itself, photovoltaics and so on. One cat comprehensive rapid response natural catastrophe. That's the cat bond we're talking about. Nat cat service. This is the database I talked about that they can sell. Wind farm insurance, electrical energy storage system insurance. These are markets that your typical insurer doesn't feel comfortable insuring because they don't know how to model that risk. Swiss Re, creating sustainable solutions. Our approach to sustainability, creating solutions for sustainability. Again, this is their new modeling they're talking about in consulting services, being a responsible investor. They're divesting from fossil fuels and so on. These reinsurers and some insurance companies as well are divesting their portfolios from coal. And they're starting to look at the other fossil fuel areas as well. In addition, many of them are refusing to provide insurance to the asset itself, the coal mines, the electrical power plants that burn coal because of the risk associated with it. So I've just tried to, in the previous slides, introduce you to the reinsurance industry, how they work, what niche they fill, and how they're moving into it. I wanted to talk about next the new technologies that they are moving into to kind of make it a little more explicit for you. As I mentioned previously, your primary insurance company doesn't know how to insure, or uncertain, I should say, how to insure these novel new technologies, like, for example, this photovoltaic farm that's floating here on this lake here. It's a novel new risk. But the reinsurance companies with their new models have the confidence to underwrite that risk and provide insurance to that asset. You all are familiar with the concentrated solar farm, but what's going on here is in this tower, there is what's called molten salt that absorbs that heat and allows this plant to continue to produce energy into the night or when the sun doesn't shine. But where does molten salt come from? The reinsurers are insuring this novel new technology. The farms or plants, I'm not sure what you call it, that produce these molten salts. Other insurance companies don't know how to, there's so much exposure to the elements that other insurance companies don't know how to underwrite that risk, whereas the reinsurers are stepping in. Munich Re is investing $20 million into this company, SPAN, which is developing this product, which is part of the smart grid technology that goes into homes. The smart circuit breakers, as well as the Alexa fund, which is part of Jeff Bezos's Amazon and all that. And who doesn't love a floating wind farm? Reinsurers are insuring this asset as well. So in the previous slides, we focused on assets, the asset itself, insured by the reinsurers. In this next few slides, we're going to do a case study on the solar revenue put, which is a new insurance instrument, new insurance product altogether. It's designed to address the problem of the wind the wind doesn't always blow, the sun doesn't always shine. So that produces a problem for a renewable energy plant, such as the Cal Flats Solar Energy Farm, which is a 173 megawatt farm out in California, built by Capital Dynamics. They built this solar energy farm to provide regular old electric utilities to a community in California. which then generates revenues back to capital dynamics, standard model, right? However, as I stated, the wind doesn't always blow, the sun doesn't always shine. Therefore, the revenues generated are variable as well. Now, this creates a problem when one wants to attract investors, because that means the returns are uncertain. And investors like certainty, so they tend to be fickle and tend not to want to invest on something if they can't know what the returns are going to be. That's when insurance companies come in and help provide some assistance here. So here we're going to rework this. We have our community here generating unpredictable revenues back to capital dynamics. Now, Swiss Re comes in and partners with KW Analytics. And what KW Analytics brings to the table is a database called Heliostats. And Heliostats is a database of the performance of 300,000 solar energy farms across the world. That's a good sample of renewable energy performance. The Swiss Re can then know how to underwrite that risk, the performance risk, not the asset, but the performance risk. They develop what's called the solar revenue put, which smooths out the revenues. They go back to capital dynamics. So it's an insurance instrument designed to smooth out the revenues, not the asset, which provides a very clear signal to investors of what the returns will be. In this case, Commonwealth out of Australia is happy to invest money in that project. So why would reinsurance want to invest in these new technologies? Because they want to avoid paying for the catastrophes that result. Catastrophes mean claims. They want to reduce their costs. If you remember, we're going to pay. Our best case scenario is it's going to cost us $54 trillion if we only hit 1.5 degrees centigrade. Worst case scenario, if we do not, or I should say best case scenario, if we do nothing, it's going to be 3.7 degrees Celsius, and it's going to cost us $551 trillion. So in summary, the reinsurers have figured out how to enter into a larger investment market with their cat bond. They're not limited to the risk pool, the standard risk pool. They're playing ball on the worldwide market now. They also have figured out how to price climate catastrophe through their risk modeling. They're developing new insurance services, the consulting services. They sell their databases to other industries, as well as their services to help them with their climate change forecasting. And they're ensuring novel new technologies. With proper signaling, the market can solve many problems. I'm going to repeat that. With proper signaling, the market can solve many problems. The reinsurance industry figured out how to put a price on catastrophe. As a result, they figured out not only how to make a living, but are thriving in the face of catastrophe. They are giddy. They're laughing their way to the bank, essentially. Consequently, they've embraced climate change and discovered new insurance markets within their risk management trade. They've developed new insurance products of risk management and developed the confidence to ensure novel, new, sustainable technologies. But it all began with developing appropriate market signals, putting a price on carbon. I'm sorry, I got ahead of myself, putting a price on catastrophe. We can learn a broader lesson from the reinsurance industries because we can look for and develop other market signals to address climate risk the way they have. For example, I mentioned I'm part of Citizens Climate Lobby. We can put a price on carbon at its source on all fossil fuels and thereby send a signal as to the true cost that fossil fuels are going to cost us. We encode that risk into the price of fossil fuels so that the consumer can know what they are buying with appropriate information as to the true cost to society for carbon emissions. The genius of the market will correct our current market imbalance, which is, in economic terms, they would say market inefficiencies, and naturally seek more sustainable alternatives. All right, so I have a couple of asks for you. When we're done here this evening, I'd like for you all to practice, put democracy into practice. And it's so easy to do. Look up your local your legislator. Look up Senator Hickenlooper. Just look him up on the internet. Senator Michael Bennet, Diana DeGette, if she's in your district. Give them a call and tell them what your priorities are for them. It could be climate, if that's what your priority is. It could be something else. but I've had some limited exposure to some of these folks. And the thing I've learned from talking to these leaders is, in fact, in a way, they aren't leaders at all. They are followers. They get their courage from us. And if they don't know what we want from them, they won't lead the way we want them to. So they get their courage from us. And I want you to give them the courage to do what you think is right by giving them a call. You can call them after hours, leave a message. You can email them. It's just easy to do. I've done it all the time. And let them know what your priorities are. My second ask is, if you like this presentation, if you thought there was value in it, my contact information is below. Please take that down. Let me know. I'd love to give this presentation to any other groups you may have connections to. It could be a professional group, it could be an employer, it could be a recreational group, whatever you think. If you're interested in other free market solutions, carbon pricing, for example, Citizens Climate Lobby has speakers who can address that. We talk about our fee and dividend solution. We talk about the conservative perspective on climate mitigation efforts, the health effects of climate change, the Christian perspective on climate change, just about anything you can name. But let me know. We'll find a speaker for you. I think on that note, I am done, and I'll do my best to answer any questions if you have them.
Hi, Greg. This is David. Not a question, but you can't see my jaw is hanging open. This is a really fascinating new perspective on looking at things. So really, congratulations. This is just a lovely, really nicely done presentation.
I appreciate that. Thank you.
Okay, and I'm going to jump in again. So I do have a question now. This is David again.
Sure.
You mentioned, I think I heard U.S. economy is about 23 trillion. Did I hear that right?
Yes.
Okay, and if by 2100, if we do nothing, climate change catastrophes will cost somewhere in the vicinity of $550 trillion. Now, even with a global economy of 200 and something, and this is from memory, by the way.
Very good memory.
In my fevered, non-economic, insurance mind, that says the entire planet goes bankrupt. You see what I mean? I mean, if we've got a $500 trillion cost and the entire global economy is making, well, producing less than that, how does that end in anything other than economic collapse? I mean, what does that mean?
Well, it's going to be take a severe bite out of the economy. Maybe I should modify that slide to put it into a little bit of perspective. So that will be 500 if we do nothing, business as usual. Best case scenario, $551 trillion. Yes, but remember, the worldwide economy, at least today, is around $225 trillion, and that's per year. So cumulatively, every year.
Oh, I see. So 550 trillion is cumulative until 2100 or so.
Yes, so I probably should put in a graph in there showing what percentage that will be. And I have seen studies that show that I think if we spend something like 1% of the growth of the GDP of the world, or we can. It's actually not that expensive to mitigate climate. I think a 1% investment over the overall GDP in the world is it 1.5%? I forget. It's been a while since I've seen that statistic. Is all it'll take to really to mitigate the worst effects of climate change. So the mitigation efforts are a bargain.
Nice. And you're right. That's a message that needs to get out there, right? Because everyone's used to looking at this as, oh no, we have to all eat vegetables now. You know what I mean? Oh, we have to do all these nasty things that we don't want to do. But when you put it that way, which is, gee, if you spend $1 now, you save $10 later, right? Or to that effect, that definitely changes people's attitudes around some of this. So this is fabulous.
Yeah, let me just say, I'm a full-blooded American. I am, Lindsay is. I embarrass Lindsay because I'm not vegan. I'm not vegetarian. I like to eat meat. I'm embarrassed. I'm not proud of that. I know how bad beef is, and there's no defense. But I like my air conditioning. I like my comfortable car. My house is too big. But I want to appeal to people's greed, honestly. If using free market principles. If we can continue to live our lifestyle, and I realize there will have to be some sacrifice. I know that not everything, we can't have everything. But I think to make this transition, we're going to have to sell people on some luxury too. Austerity just isn't going to sell. That's why I tend to favor free market solutions. We still have to cut back. We have to cut back on plastic. But if we can have cheap solar-powered electricity to power my big amplifiers and my big screen TV, that's a better selling point than telling me I have to get a small TV and look at things on my cell phone. I'm getting off target. I shouldn't go off on that. That's a personal view that goes beyond the purpose of this presentation. And this is more of a conversation over a beer, so I will shut up on that point.
Thanks, Greg. And I would never be embarrassed by you. I would like to chime in and say, so I know that there's been a bunch of questions that have popped up, and some of you confused about how people have audio and you do not. So if you'd like to ask your question via audio, feel free to raise your hand and I can unmute you. In the meantime, I will, it looks like Martin, you'd be interested in speaking, so I'm going to go ahead and volunteer you to speak first, unless you'd like me to just address this via the chat. So I'm going to go ahead and unmute you, Martin.
Okay, yeah, so my question is, my understanding is that regular insurers can only set their rates based on actuarial data, which means data gathered in the past that's then extrapolated. Does that rule also apply to reinsurers, or can they use models that they create themselves for how they assess the future is going to go?
You know, I'm not certain about the answer. I think reinsurers are not regulated. Insurance companies are licensed state by state. Therefore, they're beholden to the state regulator. It's not federally determined. Now, reinsurers are headquartered elsewhere. I do not think, I am not certain of this, Martin, but I do not think they are regulated in the same way, although there would have to be some controls. That is an excellent question. I know that the rates this year are going up something like 5 to 6%. Reinsurers are imposing increased rates on their insurers. And they have been climbing. Despite the cat bond innovation, they still have to raise their rates. And I haven't heard anything about any regulatory bodies commenting. That's my best answer, Martin, but I take that with some skepticism, because I don't in fact know, but I know some people who can answer that for me.
Yeah, thank you.
So first question from Lynn is, what's the next route of diversification? Another planet? And why do these investors want such a short stay?
If you're referring to the cat bond investors, that's the only way you can attract an investor into the cat bond. If I'm interpreting your question correctly, if you give them the full, the bond itself will be a 20-year exposure. There's going to be a hurricane in that 20-year period, and no investor, despite the returns, wants to lose all of their principal. Just not going to happen. So you entice the investor by giving them a short window, and you hopefully that investor is smart enough not to turn around and take their money out after their 2-year exposure and invest in another cat bond somewhere, or maybe they're just going to take their chances in a separate geographic location. You're taking your chances. You might want to just pull out and do something else after that. Not my world, honestly. They may assess risk differently than I do. But that's why they do the 1 to 2 year period, so as to not put at risk their equity. They want that return, but not the equity if they can help it.
Great, thank you. Steve Stevens, I'm going to go ahead and unmute you. I see that your hand is raised.
Hi, thank you for a great talk, Greg. Early on, you mentioned that the fire up in Superior and Louisville was about 2/3 were not fully insured. I'm curious, is that a general statistic that you have of most catastrophes of that scale, or is that particular to this and you actually have the inside information?
It's not inside information. I heard it on NPR, I think, just this morning. It's a standard sort of thing. It's not specifically connected to disasters, but what happens is people buy insurance and then they don't pay attention anymore. They don't think to contact their insurance agent or whatever entity they need to get their property revalued. You have to have your property revalued periodically to make sure it's up to date to get the full coverage. And as you know, this housing market has gone crazy. There's such a housing is in such short supply. The value of houses is expanding, and the insurance companies just haven't kept pace. So one way to protect yourself is to contact your agent or your bank if your house is under mortgage, and see if you can get someone to reevaluate your house, and that we can bring it up, and that you're more likely to get full replacement value if you do that. Now, do be forewarned. If your house is worth more, then your insurance premiums will go up. That's just the nature of the game. So no, it's not inside knowledge. I learned something myself just this week.
Okay, thank you.
Mm-hmm.
Great. And now, William, let's see if we can hear you.
Okay, can you hear me now?
Yes, we can.
Oh, yes.
Wow. Okay, good. All right. Yeah, I just a whole bunch of questions came up during your presentation, Greg, and I think you did a really super job in presenting a lot of general insurance principles that I didn't know. And the thing is, there one statement that you said, the reinsurers embrace climate change, and to me, it sounds like the companies like that climate is changing or getting worse. Explain that?
Yeah, I don't know how to answer that because I'm sure they don't, because yeah, their business model is doing great, yes, but remember, it's people that are populating that company, and they have to live here too, and they have kids, so they the business model itself, if you look at the corporate entity as a separate living entity, and legally a corporation is a separate legal entity, is doing well. You could say the corporation is, quotes, laughing their way to the bank and having a good time. Now, I think there is and I could be projecting, but I think there is a concern about the livability of the planet if things get really bad. So I do think there is a sincere effort to mitigate, and that's one reason. Yes, there's business opportunity in providing novel new insurance products to the assets and things like that, because there is opportunity in there. But I do think, based on the attitudes that I see portrayed in the journals, I think the employees, the execs who work for the reinsurance companies, feel like they're doing good. This may be short-lived, because it could be that if we don't take aggressive action, that the climate risk could outstrip even the worldwide market's ability to absorb that risk. It could be. But at least for the next 10 years, I'll say, I kind of pull that number out of the air, I think the reinsurers are going to be okay, I think. So I'm sure it's a mixed story for them. Did that answer your question?
A little bit, yeah. The thing in what I was hoping that was going to come out of the presentation was the conclusion that therefore the reinsuring companies, RE companies, would somehow motivate countries and businesses to do what they've been reluctant to do so far, which is to reduce the output of greenhouse gases. And I didn't really hear that kind of conclusion. because that's what I think is what we're hoping to hear, is that the RE companies are going to motivate world economies to reduce climate change by reducing greenhouse gas production. Have they done this?
Reinsurers are politically active in certain respects. They went to they go to a number of these conferences. They show up there. They do lobby. They join and create groups that are involved with climate activism and policy and things like that. But I think part of the problem, they are limited because if you remember one of the first graphs I showed you, is they're only 3% of the industry. And it's the primary insurers, it's their larger portion. It's the larger insurers who have yet to take any public positions. They murmur in the journals about climate change. They voice their concerns. They publish graphs of concern about climate change, but they don't take public action. I have sat in on some lobbying sessions with insurance executives, as well as the regulatory body that regulates the insurance companies state by state is the National Association of Insurance Companies, NAIC. I've had the privilege of sitting in on some of these lobbying sessions through my CCL affiliation, and the people who attend, who are members of NAIC, are the insurance commissioners, not the insurance executives. They're insurance commissioners for each state, and their aides and so on. Climate change is, first of all, insurance companies are very conservative. They never stick their neck out. Secondly, the commissioners are political entities, and the ones we've talked to are concerned about climate, but they will not take the first step. They won't stick their neck out. They're not going to be the one. They're waiting for somebody else to take the first step, to take a stance on climate-related issues. And this goes back to that point I made toward the end of the presentation. Our leaders are not leaders, they're followers. They're looking for someone. They need courage, and they need it from somewhere. That concerns me, because nobody's taking the lead. Nobody will take that first step. So no, the primary insurers who have the bigger voice are just too conservative. They won't stick their neck out. And I think it's the cultural, it's the times in which we live. If you look at the polls, climate change polls very high in the U.S. When you ask, how do you feel about climate change? Americans place it as high as one of their top risks. However, if you change the question to, given these risks, cyber risk, climate change, terrorism, domestic terrorism, all these different things. Climate change, I don't know what it is today, but last time I checked, it was number 6 on the list. Other things are of greater risk. So, the leaders just won't step out until climate change gets around to round 2 or 3, maybe even number 1 on the list.
Wow. Okay. All right. That sounds pretty grim, actually. So I didn't know if any of these companies are doing anything to encourage the reduction of greenhouse gas production.
Yes. A number of the reinsurers are endorsing carbon pricing, for example, and things like that. No primary insurer is that I know of. Some are divesting their investment portfolios from coal and other fossil fuels, and some are refusing to insure coal plants and coal mines. There is some action along those lines.
Okay.
They haven't made the step toward fossil fuels, though.
Got it.
Great. Thank you, Greg. And thank you, William, for your questions. I really appreciate that. And then I know we're, getting close to 8:30 here. Just a quick clarification question here. Greg, I think you may have said that 2/3 in the fires here in Colorado were uninsured, but is that under or uninsured?
Under.
Okay. That was the clarification question. And then A little bit of investment advice is being requested of you as well. Should I tell my Morgan Stanley to buy to buy me cat bonds with the reinsurers?
They are not accessible to you. I'm sorry. They only sell to hedge funds and pension funds. That's who invests in cat bonds right now. It's not that they won't. It's like, I guess it's something about how things are structured. They're just made available just to those folks.
Got it. Thank you for answering that. And then I'm just checking it. I think we are probably at time here. Thank you guys for participating in the exercise of muting and unmuting with us. It's nice to hear people's voices. And Greg, I learned so much from you. This was great. I learned not just about reinsurers, but about the. It sounds like everybody else has learned a lot too. So I'm so thankful that you put this presentation together, and it's been a long time since I first heard about it. So I'm so excited to finally get to hear all the details, and I feel certainly motivated to continue to go out and do what we can. If the insurance industries are not gonna help to divest from fossil fuels and reduce greenhouse gas emissions fast enough, and that's why groups like CRES are here, right? So that we can go ahead and try to do that. And then a few people have asked, like, as we close out here, if you could just state your email once more. Some people were not able to capture it and do have follow-up questions and would love to get in touch with you.
Sure. It's Winchell. I'll go through it a couple times. WinchellGreg@gmail.com, and Winchell is WIN as in Nancy, CHELL. Winchell Greg. I'm sorry. One word. I'm mushing together. WinchellGreg@gmail.com.
Great. Thank you so much, Greg, and thanks to all of you attendees who have joined us this evening. I hope everybody has a wonderful rest of the night, and we hope to see you all and hear from you all in February. Thanks so much.
Thank you. It was a pleasure talking. I'm pleased you all took the time to listen, and it was a pleasure talking with you all.